Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we are going to be doing a quick video on how gold stocks, and high-quality government bonds have performed during this recent downturn. Okay, so what I have here is, well, first off, I'm using stockcharts.com website, their charting service, of which I am a paid member. I will leave a link to their service in the description box below this video. I have this chart set up for a 7-day period. So what I'm looking at here is February 20th, 2020 through February 28th of 2020. So this is the week that we had the fastest correction in history. All right, so we set on February 19th, and if you haven't seen this or haven't seen it in a chart, go out and look at some of my other videos on my YouTube channel, but you'll see that we set an all-time high in the S&P 500 on Wednesday, February 19th, and on Thursday we rolled over and closed a little bit below that. So we had a negative reversal in the stock market, all right? And then we've continued to sell off from there. So what I wanted to see, I just started playing around with this idea this morning, and I wanted to make this video for you guys. I was just curious how gold stocks and high-quality bonds have performed during this downturn for those people that might be asset allocators. Intuitively, right, you would think that gold would perform well during that time frame. But let's take a look here. So what we're going to be using here is the ETFs to represent these spaces. So the GLD, of course, that's the ETF for gold. GDX, that's the gold miners, the large caps. GDXJ is the small cap miners, gold miners. The TLT is the 20-year bond ETF, and the IEF is a 7 to 10-year bond duration IEF, high-quality bonds. So what we can see here, and again, over the last 7 days, is the spider, the gold GLD, that is down 2.64%. Now, intuitively, you would think that gold would do well in a downturn like this. So this is good for us to review because things don't always work the way we would think they should work, right, in these downturns. So it's important to understand this. So the GLD was actually down 2.64% during the last 7 trading days. The large cap gold miners, the GDX, was down almost 12%, 11.87% during that time frame. The small cap miners, the GDXJ, down 17.62% in the last 7 trading days. And then we have the longer duration high quality government bonds up 5.89%. And then the 7 to 10 years, so still a decent duration, but a little shorter, half the duration, of course, of the TLT, the IEF, which represents the 7 to 10-year U.S. government bonds, that was up 3.05%. So again, I hope this is helpful. I hope you understand that, look, as low as durations are, if somebody's going to continue to be an asset allocator, and I'm very concerned about the global bond market, I think that if there's any major catastrophe on the horizon, and guys, I don't know whether it's a couple years out or a couple of decades out, but I think the bond market is the scariest thing out there based on my decades of experience in financial services and decades and decades of trading and investing. You've got yields. We set an all-time low on Friday the 28th. We set an all-time low yield on the 10-year Treasury, and I believe most all the other durations as well, but I know for a fact on the 10-year Treasury, U.S. 10-year Treasury yield, we hit an all-time low. And also, guys, keep in mind on bonds, whatever your yield is over time will more than likely be your average annual return. So, for instance, and I'm just going to use easy math here, if the U.S. 10-year Treasury is paying 1.5% on the yield, and it's a 10-year bond, if you hold that thing for 10 years, your average annual return is going to be somewhere around 1.5%. And keep in mind that is taxable, okay? Even if you put it inside of your IRA, at the, whenever you take that distribution, whether it's for your required minimum distributions or whatever, when you take that out, you're going to pay taxes on that money, all right? So just understand that, yes, in the short term here, these bonds have helped out, if you are doing a 60-40, 70-30 portfolio, the bonds definitely helped you more than gold did, as we see here. All right, and the longer duration. So keep in mind, as yields go down, bond prices go up. And so the longer the duration, the more interest rate sensitive a bond is. So as the yields fall, you get the opposite reaction on the bond price. And that's why in 7 days, 7 trading days, this fund is up almost 6%, or the ETF is up almost 6%, and you've got over a 3% return on the 7 to 10 year treasury. But understand, these things can go backwards on you as well. All right. So in the short term, the high quality bonds for this last 7 trading days have definitely worked out better than gold or gold miners to help protect your equity portfolio, to help offset equity risk. However, over time, understand that I think the global bond market is a ticking time bomb. So just be super careful with that. Watch some of my other videos out there on my YouTube channel. And if you haven't already done so, please subscribe, give me a thumbs up, leave me a comment, and I'll see you in the next video. If you would like to learn how Simple Market Signals can help you become a more successful investor, trader, or financial advisor, you will want to watch the video introducing Simple Market Signals, which is on my YouTube channel. I will also leave a link to that video in the description box below this video. Thank you for watching. Don't forget to subscribe, and please give me a thumbs up on this video, leave a comment, and I look forward to seeing you in the next video.